Welcome back. Well, as promised, let's put the spotlight on commodities now. Jenson Ong, the Asia team leader at Pricing Metals Non-Ferrous S&P Global Commodity Insights, joining us on the show right now. Hi, Jenson. Good to be speaking with you. Thanks so much for making time and speaking with us. Now that the big Fed event is behind us, what's the outlook that you have on the non-ferrous metals? Because after seeing a significant fall from the May 2024 highs, the non-ferrous metal space has rebounded of late, at least from the September 9 lows that we have seen. Do you think the uptrend is sustainable and from here on we'll see a bigger recovery?
Non-ferrous metals, of course, looking at the main couple of metals, like let's say nickel, aluminium, copper, for example. In terms of the rebound in prices, of course, in the recent months or so, the trend is a lot of supply tightness stemming from the upstream markets of these metals for nickel ore, for example, aluminium, upstream alumina and copper concentrates as well. So in nickel itself, of course, we still see continued tightness in terms of the Indonesian ore in particular, which is a main supplier or main producer on a global scale for the nickel market. So we do see that rainy weather and also mining approval delays in Indonesia itself could continue to sustain tightness in the nickel market as a whole. For the copper markets as well, copper concentrates treatment charges on the upstream have continued to be at record lows, although there's some rebound due to a fire at China's Daye copper smelter, which is one of the major smelters in China, that could be supporting copper prices in the near term. While for the aluminum market as well, in the recent news of a potential disruptions out of India, actually, due to the disruptions to one of the water catchment facilities at the alumina refineries in India itself, all the upstream factors could continue to support prices in terms of a sustainable rebound. But having said that, we do note that across all metals, let's say for markets for like China, for example, demand side has not shown a strong improvement across the board. So we do monitor that there's a risk to the rebound being not sustainable as well, in that sense where we might not see a sustained rebound, but perhaps more of a immediate knee-jerk reaction to supply side tightness as well as a immediate response to the Fed rate reduction.
Okay, but what are the levels then that one should watch out for when it comes to aluminium as well as copper for, let's say, end of this year?
Right, for copper and aluminium, I think the key levels that generally we're looking at across the market is for copper, LME copper would be about 9,500 level as either a guidance level for whether it's a resistance or a support level, a key psychological level. For aluminum itself, it would be 2,600 LME aluminum for the price as well. So these are key levels to see whether the market might reach these levels, whether they could be support levels for these prices, and these would definitely be in the medium term outlook. It will be definitely dependent on the continued supply tightness in the upstream markets of these copper and aluminum markets, namely the copper concentrate and the alumina markets. They have seen continued a rally in upstream prices, which have also provided some certain extent of support to the downstream LME copper and LME aluminum prices. But at the same time, we do know that these markets are operating in different fundamentals. So with the upstream tightness and coupled with the contradicting lackluster demand from the downstream metals, we could see a push-pull factor in terms of having stronger upstream cost support, but at the same time weakening demand price support from the on the downstream end as well.
Okay, and then what's the target you have in mind for LME, zinc as well as nickel by this year end?
In terms of LME nickel, we do observe that because of the strong influence of pricing influence from the Indonesian country due to a strong increasing production volume and capacity, I think across the board we do see guidance at around 17,000 LME nickel for LME nickel itself, where the main factors that could push prices up or down would be, for example, the nickel ore tightness in Indonesia itself, where the main producing country is actually importing ore from other countries such as Philippines. So that's one of the upstream supply tightness for the base metals. On the downstream side, of course, we do see that across for stainless steel, for example, steel demand continues to be at a lackluster spot as well. So we do see that some factors are also pulling prices on a downward trend on both sides of the equation.
And what about the entire take of the elephant in the room, and that's China? How's that expected to play out, you believe?
I think China factor itself, we did observe widening steel output cuts in August itself, which did trigger a slight rebound in steel prices in the first half of September. But overall, the market outlook remains subdued for the steel market, with end user demand in China expected to be remaining under pressure in the near term. So China did produce about 68 million tons of pig iron and 78 million tons of crude steel in August, which is down about 10% year on year. So China's property sector as a whole and the overall steel demand in China itself, we do see that it's based on market feedback and market prices, is still on a somewhat structural downtrend. So we don't expect the steel market to have an immediate improvement in terms of demand and prices unless excessive pig iron and steel making capacity in China is priced out or squeezed out of the market.
Okay, so that's about China, but what about the recession fears in other countries? What's the latest with respect to the demands in other part of the world?
I think right now, because of the guidance or the leadership of the US Fed, where they have started to cut rates, showing that inflation could be cooling, and labor markets signals of cooling down as well. I think across the board for the Western world, besides China itself, I think there's some optimism in terms of improvement in demand and also improvement in base metals prices and demand. But that would be more of a longer term view, and not only the demand side, but also because of supply tightness that from the upstream markets continue to be a main factor in terms of supporting prices as well for, let's say, nickel, aluminum, for example, aluminum in particular in recent times as well, where the upstream aluminum price have skyrocketed a lot. So the benchmark Platts FOB Australia alumina prices have increased from, let's say, 400 plus levels to the current SS level of 542 FOB Australia, which is perhaps a $50 increase on a month-on-month basis as well. So we do see that upstream prices continue to have a strong supporting factor for downstream aluminum prices, and it could be the case where downstream, let's say, aluminum smelters might have to curtail production due to high upstream costs. But at the moment, in the short term, we do see that this price is still being priced in and sustainable for the aluminum market as a whole.